Thank you, Komal. Thank you, Taxman, for having asked us to be with all of you this afternoon, evening, to discuss about the tax implications of the joint development arrangement. I am blessed to be with my partner, mentor, my co-author, Dr. Raj K. Agarwal. We remember that in 2016, when the first edition of this book on joint development agreements, tax issues came, at that time, section 45, subsection 5, capital A was not on the statute. And therefore, the taxation issues relating to the joint development arrangements now were in a very fluid state, in the sense that there was no specific provision made on the lines of section 45(5)(a). And in fact, this joint development arrangements taxation issues have always engaged not only the taxpayers but then the tax professionals and the tax administrators alike. And as I said a little while ago, that this is for the reason that various situations in case of the joint development arrangements are not in a fixed position, and there are no clear-cut answers to various issues. For the landowners, there are different kinds of issues. For the real estate developers, there are various kinds of issues. Then came on the horizon section 45, subsection 5, capital A. Now even that section now has confused more than what it has solved. So we will come to those issues, but then kindly see that in case of joint development arrangements, I mean, what can be the various parameters, I mean, which have always engaged us. Now in case of the landowners, now it has to be ascertained if at all he was holding this asset as a capital asset, and whether it was an agricultural land, and in case he was holding such asset as a business asset, because each variant or each variation, I mean, will involve different tax implications. Then the issues would be different in case some capital assets held by the landowner are converted into the business assets or the stock in trade, and then is thrown for the purpose of the joint development arrangement. Now, if it is a capital asset, now whether it is a long-term capital asset or short, because each variation, as I said, now would give different implications of the tax horizon. So if it is a long-term or if it is a short-term, and at which point of time the transfer has taken place, if at all the transfer has taken place or not, that itself is a vexed question. And in case it is found that the transfer has taken place, then at which point of time the transfer is taken, because the point of transfer of that capital asset which has gone into the joint development agreement, now that has got its own implications. Then what is the sale consideration? Now whether it is in kind or whether it is in cash or whether it is the combination of both, and whether it is, if at all it is determinable or not. Now even that question is there. Now if sale consideration is to be deemed on the lines of section 50C or section 43CA, even that is also an issue. Then cost of acquisition and cost of improvement and expenses in connection with transfer, because the capital gain now is to be worked out by reducing these costs element from the sales consideration or the deemed sales consideration. So there are several offshoots of these cost of acquisition, and in case of cost of acquisition, in case of the long-term capital asset, then the indexation, and then the exemptions in case of long-term capital asset, then whether the exemptions of the section 54, 54A or 54B, depending upon the nature of capital asset which has been sold or transferred in joint development. So it would be suffice to say that in the case of the capital gain or in the case of the joint development arrangements, now all these variants, variations, nitty-gritties, nuances which are involved in all these facets, now throw several kinds of challenges for the taxpayer. And when we were discussing, I and Dr. Raj were discussing as to how to go about it, then we thought that since we will be speaking before the well-informed audience, therefore we will quickly take and traverse through the provisions, bare provisions of section 45(5)(a), because it may not be possible within a span of 2 hours to deal the tax implications for the landowners and for the developers and for the joint development arrangement which are covered under section 45(5)(a), or those joint development arrangements which are not covered by section 45(5)(a). So we have decided that we will distribute our deliberations in 2 or 3 webinars, and of course subject to the approval of the taxman, whereby we will cover this entire topic from all possible angles and from the standpoint of the landowners and the real estate developers. So today what we have decided and what we have thought, and even for that matter the taxman has also circulated as to what is the scope of our today's deliberations, that will revolve around to section 45 subsection 5 capital A, which are the specific provisions made by the legislature for the purpose of taxability out of the joint development arrangements in certain situations. So we will first of all discuss about the general provisions quickly, so that we recapitulate ourselves to that basic concept, and then we will traverse through the various issues which are contentious issues, and then on which I and Dr. Raj both will express our opinions. And on most of the occasions, since we are the co-authors, so you can take it that our opinion would be converging at some stage. But then when there are more than one brains, then it cannot be ruled out that there may be divergent of opinion also. But and nonetheless, let us begin. Section 45 subsection 5 capital A. It was brought on the statute by the Finance Act 2017, and the date of operation of this provision was made effective from 1st of April 2018. And if you ask me, that it will be applicable from the assessment year 2018 and 19. Now this section has overridden the normal provisions of the taxability of capital gain, which are given in the subsection 1 of section 45. You may recall that section 45 subsection 1 now seeks to tax the capital gain arising on the transfer of a capital asset in the year of transfer of the capital asset. Now, to that extent, subsection 1 of section 45 now is sought to be overridden, because the subsection 5 capital starts with a non-obstante clause, and it says the notwithstanding anything contained in subsection 1. So we can now take it that subsection 1 is overridden by subsection 5 capital A. And then it says that the capital gain which arises to an individual and HUF from the transfer of a capital asset, and that capital asset should be land, building, or both, and that transfer should be under the specified agreement. Then in that situation, the capital gain so arising to individual and HUF in such circumstances will be deemed to be the capital gain, will be treated to be the capital gain of the previous year in which certificate of completion is issued by the competent authority for whole or the part of the project. And the stamp duty value of the land or building of his share as on the date of issuance of the completion certificate, that will be deemed to be the full value of considerations for the purpose of section 48. Full value of consideration received or accruing as a result of the transfer of the capital asset. So section 45(5) capital A has been made applicable only when the specified agreement is entered into by an individual and HUF. It is not applicable in case of other persons or entities. It is applicable when there is a transfer of a capital asset, and that capital asset has to be land or building, and or the amalgam of both, land or building or both. Then in that situation, the taxability arising on the transfer of such capital asset will not be there in the year of transfer, but it will be taxable in the year when the competent authority issues completion certificate for whole or the part of the project. And as on that date, the stamp duty value of the land or building falling to the share of the landowner now shall be deemed to be the full value of consideration. Then there is a proviso which has been given in section 45(5) capital A, which says that provision of this subsection shall not apply. The provision of subsection 5 capital A will not apply in case the landowner transfers his share in the project before the date of the issuance of the completion certificate. Then in that situation, the proviso says that the benefit or enabling provision of subsection 5 capital A will not apply, but the normal provisions of the Income Tax Act which are there or which would be there had the subsection 5 capital A not been invoked, that would apply. Then there is an explanation, and that explanation defines three terms: the competent authority, the specified agreement, the stamp duty value. So competent authority, obviously the authority which has been empowered by the state for issuing the completion certificate. And the specified agreement has been defined to mean a registered agreement under which the person owning the land or building or both agrees to allow another person to develop a real estate project on such land, and in consideration of which should either be in kind or the amalgam of cash or in kind. So if it is purely in cash, then provisions of section 45(5)(a) now will not be operative. And a stamp duty value means the value adopted, assessed or assessable by any authority of the government for the purpose of payment of stamp duty. So subsection 5 capital A of section 45, though is not a very lengthy section, but each point into it now has got some meaning. And because it has got some meaning, and at times there is absence of meaning also, now that existence of meaning and absence of meaning, now this situation creates several contentious issues. So as I said a little while ago, that we both are conscious that our audience is a well-informed audience. Therefore, plain provisions may not matter much to them. They all are well versed. But then what should be, or what are the contentious issues in the context of section 45 subsection 5 capital A, and that we would like to deal with. And thereafter, after we express, we both express our opinion, thereafter if there are questions, then we would be pleased to undertake. So with this background, now if I would request Dr. Raj, now whether he would also like to say something as an introduction of today's discussion, and then I'll pick up certain contentious issues, which are around 17 or 18 issues. Now you can very well imagine that with this not very exhaustively worded section, there are 15, 16, 17 contentious issues. So you can very well imagine that how many were the issues without absence of 45(5)(a). So with this, I'll now hand over the mic to Dr. Raj, that if he wants to say something about the introductory aspect of this chapter, of this topic.
No, we can start with the contentious issues, and simultaneously we will keep on discussing whatever the input I want to add.
Okay. So as all of you know, that the Finance Act 2017 now has inserted subsection 5 capital A on the statute, and the ostensible effective date is 1/4/2018, that is on and from assessment year 2018-19. Therefore the question comes that even though the legislature says that it will come into operations ostensibly from 1/4/2018, now can there be any occasion whereby one may be tempted to give effect to these provisions with a retrospective effect? Yes, Dr. Raj, if you want to say, then I will.
You can please address this.
Okay. So now this 1/4/2018, though the plain and simple law is that a law has to be read literally. When the legislature says that a particular provision will come into effect from 1/4/2018, then it should come into effect from 1/4/2018, and there is judicial decision now which has held, Hyderabad bench of the tribunal, which has held that this provision now will come into effect from assessment 1890. But if you read the memorandum, when this provision was introduced, then that memorandum took note of the genuine hardships being followed in such cases, and therefore the legislature said that in order to quell that kind of genuine hardships, in order to mitigate that genuine hardships, then subsection 5 capital A of section 45 now was proposed to be brought on the statute, and eventually that was brought on the statute. Therefore, in the light of this award background of the introduction of subsection 5 capital A, the very first question now, which is not a non-starter question, which is a very relevant and germane question, despite that question having been answered by Hyderabad bench of the tribunal that it will come into effect from 1st of April 2018, yet that question, whether it can be given effect with a retrospectivity, now that still reaches, that still persists, that still exists. Because you may be knowing that a rule, mischief rule of interpretation, that if there is some genuine hardship, now which is sought to be remedied by making an amendment, then the very existence of the genuine hardships in the past now may be one of the factors which the honorable courts may take into account while interpreting the effectiveness of that provisions with retrospective effect. Therefore, one can make out a case, because after all, one decision of the tribunal, now that is not the end of the road. And therefore, that argument that if an joint development arrangement has been entered into by an individual or HUF, even prior to 1/4/2018, or I mean prior to 1/4/2017, now even now can be roped in under subsection 5 capital A of section 45. Though the rule of literal interpretation is that we have to see the law as it stands. And therefore, when the legislature says that it is to come into effect of 1st April 2018, that means in ordinary circumstances that it will come into effect from assessment 2018-9. But since, as I said, and even at the cost of repetition, I would say that since we are speaking before a well-informed professionals, well-informed audience, therefore this angle of argument now, according to in our, or at least I can say for myself, in my respectful submissions, can be made available. Yes.
Yes, it's all right. We can move to the next question.
Okay. Yes. Now the second question, the second issue, now which comes to our mind is now whether transfer of land to the developer. Now this is where something which is very important. Now whether the transfer of land to the developer, when the joint development arrangement is entered into, is a necessary condition precedent for applicability of the provisions of section 45 subsection 5 capital A. Now, because if the transfer of land to the developer now is not made, and still section 45 subsection 5 capital A can be invoked or not, this is the issue on which I would request Dr. Raj to kindly give his mind.
Yes. In fact, this is a very important question to be addressed, in the context of applicability of provision of section 45(5)(a), because 45(5)(a) is creating a deeming fiction wherein the chargeability of capital gains tax in case of transfer of land by the landowner to the developer has been deferred or has been prescribed to be in the year in which completion certificate is issued by the competent authority for the project. But first of all, the question comes, because if there is a joint development agreement of such a nature where there is no transfer of land is taking place from landowner to the developer, in that case, whether 45(5)(a) would be applicable? So the simple answer is no, because what we are examining here, we are examining that there is a joint development agreement, and the why there is there are joint development agreements entered. The very basic thing is that these are the projects of huge investment. Land itself is a huge investment. Developer is not having the finances to the extent that he can outrightly purchase the land, develop the project, and then sell to the customers. And on the other hand, there is landowner who is having the land. If he wants to sell it, then the price which we can fetch must be lower. But if he enters into a joint development agreement with the developer who develops the land in the developed real estate at his cost, then the value of land which he may fetch may be much higher, but the payment may be deferred to be received in installments. So it is a kind of a arrangement between both the parties where one is contributing land, another is constructing the project on that is superstructure, for which investment is being made by the developer. So the kind of JDA, the manner in which these are formed, these are entered, there are a lot of complications, and the complex manner in which the terms are provided between the landowner and the developer makes it more difficult to determine, because for the purpose of calculating capital gains in the hands of landowner, so we are talking when landowner is having the land, which is a capital asset, not the business asset. Only then the question of capital gains and section 45(5)(a) comes into the picture. So if landowner is contributing land to joint development agreement, so there are for the purpose of calculating capital gains in the hands of landowner, we have to determine three things. First of all, whether there is transfer of land from landowner to the developer at any point of time, and to what extent, whether the entire land is being transferred or part of the land is being transferred. Number one. Number two, what is the date or year of transfer of land? Because taxability, as per the general provision of section 45(1), is applicable when there is a transfer, the year in which there is a transfer. And third is, what is the value of the sale consideration? So we will address all these three issues and how 45(5)(a) has created a deeming fiction, particularly with respect to second and third issue. That is the year of transferability of the land and the value of the sale consideration of the land transferred. But prior to these two questions, first of all, we have to see whether at all there is a transfer of land by the landowner to the developer.
And to what extent?
And to what extent? And to what extent? Both the questions are to be addressed. So I just give an example, and particularly there may be joint development agreement of such a nature, and these are very much prevalent in west and south part of the country, and this is the right spirit in fact of the joint development agreement, where land is being contributed by the landowner, construction or superstructure is being developed and created by the developer, and then to the customer, both are selling their part, their assets, as a tripartite agreement. So in that situation, a tripartite agreement is entered with the customer, where it is stated that landowner is transferring the undivided portion of the land which is involved in the particular developed unit or flat. Developer transfers the superstructure which he has created on that undivided land portion, and then the ownership goes to the customer directly of the land from the landowner and of the superstructure from the developer. If such kind of arrangement is there, in such a case, there is no transfer of ownership of land by the landowner to the developer. It is directly being transferred by landowner to the customer, and developer is transferring superstructure to the customer as per a tripartite agreement. In such a situation, there is no question of attraction of the capital gains in the hands of the land owner with respect to the transfer of land to the developer. There is no transfer of land to the developer. Then it is not needed. It is not taxable at that point of time. So such kind of all joint development agreements comes out of the purview of 45(5)(a), because there is no transfer even for 45(1) also. Then, because transfer of land is one thing and transfer of the developed real estate on that land is another thing. These are two distinct assets. When we are talking of section 45(5)(a), primarily, first of all, we are discussing when there is a transfer of land by the landlord, by the landowner to the developer. We are not talking of the transfer of the developed unit later on. That is the second part. But first of all, what we are addressing, that when land is being transferred by landowner to the developer. And so I gave one example of joint development agreements which are entered in ample numbers in number of cases, but there is no transfer of land by the landowner to the developer. Another example I give, and very controversial, we can say, or very prevalent form of the joint development agreements. There is a plot of, say, 500 square yards. 4 floors are constructed, where a JDA, joint development arrangement, is entered with the developer. That 4 floors will be developed. 1 will be taken by the developer and 3 will be taken by the landowner. In this kind of arrangement also, whether we will have to examine that whether any land is being transferred by the landowner to the developer, and at what point of time and to what extent. Only then we can say that any question of attraction of capital gains tax on the landowner arises. And now question comes that when we can say there is a transfer of land from the landowner to the developer, because transfer of land, we can say, when the ownership rights of the land are transferred by the landowner to the developer. Ownership rights, what does it consist of? When the developer gets the rights to use or dispose the property or the asset or the land at its own discretion, then we can say that the ownership rights have been transferred. Unless only to give the possession or to give the rights for developing the real estate, for doing the construction activity or development of the project or superstructure on the land, does not mean that the ownership rights of the land have been transferred by the landowner to the developer. So when we say that there is a transfer of land or transfer of asset, then it necessarily means that all rights of ownership have been transferred. There are so many judgments of the Supreme Court which have been delivered in this context, and in the context of section 53(a) of the Property Act, prior to 45(5)(a), when this controversy was there, at what point of time transfer has taken place. So I am not going now presently at what point of time transfer has taken place, but I am on the point whether at all transfer has taken place. So when we say that transfer has taken place, it means at any point of time. It may be prior to getting the completion certificate, it may be after getting the completion certificate of the project, but at any point of time, there has to be transfer of ownership rights from landlord to the developer, to the nature that developer is in a position to use or sell that part of the land which has been transferred at its own discretion. So when I gave the first example that tripartite agreement is created, land owner is transferring his part of the land, undivided portion of the land, then developer is not getting the right to transfer the land. The ownership of land as per the civil law cannot be transferred by developer, because no, unless you have got the rights of something, how can you pass it on? So first of all, there has to be transfer of ownership rights in land from the landlord or landowner to the developer. Only then we can say that there can be attraction of section 45(5)(a). Otherwise, to my mind, there cannot be any attraction of section 45(5)(a), because then if there is no transfer, then there is no question arising regarding the attraction of capital gains in the hands of the land owner when no land has been transferred. So this is one part. And second part is to what extent. This is also important, because if the joint development agreement is of the nature that certain portion of the developed real estate shall be retained by the developer and certain portion shall be given to the landowner, say around 50-50%. That after the land has been contributed, developer will create a superstructure, he will make investment in the construction, and then 50% of the developed real estate will belong to the landowner and 50% will belong to the developer. It means what landowner has transferred, he has not transferred entire land, the rights of entire land to the developer. He has transferred the rights of the 50% land only, which is going to the part of the developer, and only that part has been transferred. So capital gains shall be required to be calculated, and it would be taxable only on the part of the land which is falling in the share of the developer. The land which is falling in the share of the landowner, which has not been transferred, only the thing is that on that land the developer has created superstructure, he has developed the project, and it has been given to the landowner. So the superstructure on the part of the land of the landowner which has been created is the consideration. The value of the superstructure is the consideration for the land which has been transferred by landowner to the developer, and that land is the part of the developer estate which is falling in the part of the developer. So both these questions have to be looked into, addressed, and only then we will see that how the provision of section 45(5)(a), or for that matter even 45(1) shall be applicable. Yes, Dr. Gupta.
Yes. So, and that is why if you see section 45 subsection 5 capital A, now it says that for the purpose of section 48, the stamp duty value on the date of issue of the said certificate of his share, being land or building or both. Now, if this interpretation is not given, and if it is taken this entire land has been transferred by the landowner, then the share which he would get, including his own land, now stamp duty value, now if it gets taxed in the hands of the landowner, that will bring the absurdity, because what he has transferred, now in the example which Dr. Agarwal gave, the 3 floors and 1 floor, that 75% land is retained by the landowner, 25% land now is transferred to the developer. Now, in consideration of the 25%, that 3 superstructure or the superstructure on 3 floors, now this landowner has got. So the stamp duty value in relation to the superstructure of that 75%, now that will constitute the deemed sales consideration as per this. So now with this, we move to the next contentious issues. Now, whether consideration received by the landowner only in the form and by way of share in the sale proceeds of developed real estate units, whether would entitle landowner to claim benefit under section 45(5)(a). Now, the necessity of this question arose because of the definition of a specified agreement because as per the plain reading of the specified agreement, now what is mentioned that this 45(5)(a) will not be there in case the consideration is not received by the landowner partly in kind. It can be partly in kind and partly in cash. But then if it is purely in cash, then 45(5)(a) will not be applicable because that will not be treated as a specified agreement. And therefore, in that context, this question, now what can be the variation?
Yes.
Whether consideration received by the landowner should be only in the form of combination of kind and cash, or maybe exclusively in kind. But then if it is exclusively in cash, even by way of share in the sale proceeds of the developed real estate, now whether 45(5)(a) now can be made applicable or not. Yes, Dr. Agarwal.
Yeah, yes. Now as the Dr. Gupta has said, that this question has arisen for the reason that section 45(5)(a) is covering only those specified agreement where some portion of sale consideration is received by the landowner in kind. Now, when we see the nature of joint development agreements and the way the terms and other things are provided in the joint development agreement, the sale consideration can be provided in three ways. One is totally in monetary terms, that this is the value of the land which is being transferred, and the value is specified as say 50 crore rupees, which shall be given by the developer to the landowner, and the timing of the payment may be prescribed, that along with the development or along with the sale to the customers, etc., shall be given. If it is given right in the beginning, then it is a purely sale transaction. Then there is no need of joint development agreement. Joint development agreement comes into the picture when developer is not having the resources enough to pay outrightly to the land owner, and the payment is being linked with the development of the real estate and with the sale to the customers. Out of the sale receipts from the customers, the payment is made simultaneously to the land owner, maybe within a period of 4 or 5 years, the time within which is taken in development of the project. So one can be the total amount is prescribed in monetary terms. Second, maybe when there is a division of the developed real estate in kind. So as the example I gave earlier, that out of the total developed real estate, 50% shall be given to the landowner and 50% shall be retained by the developer. So this is another form. And third form maybe, and which is also very much prevalent, and in a lot of JDAs we have seen that certain percentage of the sales revenue is prescribed. That whatever the sales revenue is fetched by the developer, say 40% of that will belong to the landowner. So instead of saying that the amount is fixed in monetary terms, neither the in-kind developed real estate is being given to the landowner, they are saying that the total sale revenue which will be fetched by the developer, a certain percentage, maybe say around 40% of that, shall be given by the developer to the landowner. So whenever there is a sale proceeds coming, then generally they open a escrow account, and out of the escrow account, 40% goes to the landowner, 60% is retained by the developer for the purpose, whatever the terms has been decided regarding the transfer of the funds or the liquidity at what point of time, whatsoever it may be. But these are three different forms. If first form is there, when consideration is in monetary terms, then clear cut, it is not covered in 45(5)(a), because it requires that some portion should be in kind. Along with kind, some amount may be in cash, in monetary terms, but entire amount is in monetary terms, then 45(5)(a) is not applicable. Second, third situation, if it is in kind, then there is no problem. It is covered within the ambit of 45(5)(a), absolutely no problem. But if it is a in-between situation, that certain percentage of the sales revenue is being given, whether it can be interpreted to mean that there is in fact there is developed real estate which is being given to the landlord, and simultaneously the landlord has required the developer to sell it and give the percentage of the revenue to him. So there can be two things. If it is in kind, then the real estate would be earmarked. 50% is landlord's share, 50% is developer share. It means there are 300 units, then 150 units and earmarked units would be going to the landlord, and another 150 units will be retained by the developer. But here we can say, just to establish the argument, going beyond the literal interpretation of the terms which have been used by the legislation, going to the spirit according to which this section has tried to resolve the controversy, that entire project, out of the entire project, if 40% is belonging to the landlord of the sale proceeds, it means that the landlord is having share of 40% in kind in the entire project. Instead of earmarking of the particular units in the entire project, 40% share belongs to the landowner, which is being sold by developer on behalf of the landowner, and proceeds are being passed on by the developer to the landowner. If we borrow this argument, then we can interpret that this kind of arrangement may also fall within the ambit of section 45(5)(a). It cannot be said that it is not fulfilling the condition of being in the nature of a specified agreement, since nothing in kind is being received by the landowner. Because the uncertainty of calculating the sale consideration which was involved when in kind asset in kind developed estate is received, that is the reason why deeming fiction of assuming the stamp duty value as on the date of completion certificate has been presumed or has been prescribed by the legislation to be the sale consideration. And if that is the objective, that uncertainty is existing even in the case when percentage of sales revenue is being passed by the developer to the landowner. So this is a matter of interpretation, and I am of the strong belief, and Mr. Gupta may also give his opinion, that such kind of arrangement should also fall within the ambit of section 45(5)(a), because units may not be earmarked, but he is having a share in the entire project to the extent of the percentage of revenue he is getting, and the uncertainty of the calculation of the amount, when the revenue will be fetched, when the amount will be received, is also existing. And that was the primary objective for which 45(5)(a) was brought into, that uncertainty of the date of transfer and uncertainty of calculating the sales revenue was to be addressed. Keeping in view this, I think one can make this interpretation. Yes.
Yes. So, though if we go strictly by the rule of literal constructions, there may be some problem because it says share being land or building or both in such project. But then, in case this has so happened, where the sales revenue have been shared by the developer and by the landowner, then also a case can be set up that the sales revenue in respect of the portion of the real estate, developed real estate received by the landowner now is nothing but his share in that, but his share being land or building or both in the project. And therefore, I mean, but then the litigations cannot be ruled out, as you know. Now, even if you go strictly by the rule of literal constructions, that has been my experience, that the litigations, even that situation cannot be ruled out. Now, here we are taking the help of the constructive possession, maybe for a fraction of moments or fraction of seconds, for it on behalf of the landowner. And then we are saying this apportionment of the sales revenue when that developed real estate project is sold now is nothing but the constructive possession of the share in the land or building of the developed real estate. So litigations cannot be ruled out, but then if it has so happened, then the arguments can be made on these lines. So this was one of the facets which we thought that we should share with all of you, that even the apportionment of the sales revenue in the developed real estate project may also be pitted by the landowner as if he has received considerations of his share, being land or building or both, in such project. And therefore, this can also be a facet of an argument. So moving forward, the next question. Now, whether section 45(5)(a), now whether creates a fiction about the transfer of land to the year of issue of completion certificate. Because if you see, under section 45 subsection 1, the taxability of a capital gain under subsection 1 is at the time or in the year in which the transfer has taken place. Whereas taxability of the capital gain under subsection 5 capital A of section 45 happens in the year in which the competent authority issues the completion certificate for whole or the part of the project. Now, whether would it mean that the legislature has created some sort of fiction even to shift the year of transfer from the real year of transfer to the year of issuance of the certificate, completion certificate, because there are several other issues which are connected with the year of transfer. And therefore, this question came in our mind. Now, whether there is a fiction of the taxability of the capital gain in the year when the competent authority issues certificate, or whether this fiction of even the year of transfer has also been shifted to this year. So, yes.
Yes. Again, this is a very interesting and significant question, that the legislature has very cautiously not used the word deemed transfer in the year of issue of completion certificate. Because when taxability is being shifted in the year in which completion certificate for the project is issued by the competent authority, then for all purposes, it should be deemed that the year or the date on which completion certificate is issued should be the date on which there is a deemed transfer of the land by the landowner to the developer. Only then taxability is there. But legislature has not very wisely not used the word deemed transfer. There can be two reasons for this. One is what Dr. Gupta has said, that so far as the transfer is concerned, there are other implications which we will discuss regarding the determination of the holding period, the indexation, etc., and then deduction or exemptions under section 54(b), 54, section 54, section 54(f), etc. So those are all are linked with the date of the transfer. But here they have not said that this date would be constitute to be the date of the deemed transfer. And second reason which I feel is from the point of view of the transfer of the ownership. If they say that this is the date of the deemed transfer, then whether the ownership is being transferred on this date, and ownership, transfer of ownership of land is a civil matter. It depends upon the documentation, how it has been done regarding from the point of view of the civil angle, how the ownership of the land is being received by the landowner to the developer under the civil law. That is more important. And from that point of view, if it is prescribed that this is the date of the deemed transfer, then there may be a clash of the situation under both the acts, because Income Tax Act is more concerned regarding the collection of the taxes, and for that they have created a deeming fiction. But if they say that this is the date of transfer, but documentation which has been made, like conveyance deed, I give a very simple example, that the completion certificate has been issued in 2022, but the conveyance deed of the land was executed by the landowner to the developer in 2020 itself. Now, when would be the taxability? At the time when conveyance deed was executed, because the transfer under the civil law has taken place, the transfer of ownership in that year only. But if we invoke section 45(5)(a), then even when conveyance deed has been executed, there is no taxability in the hands of the land owner. It would be only in the year 2022 if provision of section 45(5)(a) are applicable. So therefore, deliberately, instead of using the word as deemed transfer, though they mean it to be deemed transfer, because the taxability is linked from the date of the completion certificate being issued by the competent authority. So, there is no clash of the situation in both the acts, and the ownership rights may be transferred. I am saying that there should be transfer from landowner to the developer. That is important. But the year or the date of transfer is not relevant at all for the purpose of section 45(5)(a). It may be prior to issue of completion certificate. It may be after the completion of certificate. At any point of time, it may be there. That is not significant. That is not important. That is not the relevant factor, because the taxability is not linked with the date of transfer. The taxability is linked with the issue of the completion certificate. The calculation is also to be made in that year, and chargeability to tax is also in that year. So this is very important to understand that so far as the date of transfer is concerned, it is not relevant for the purpose of section 45(a) to determine the year of date of transfer. But again, I am repeating the first question which we addressed. There has to be transfer. Unless there is a transfer of land from landowner to developer, there is no question of creation of any taxability or chargeability of tax in the hands of the landowner.
Yes.
Yes.
Now, yes. Now, kindly see, there is section 45 subsection 2 also. Now, 45 subsection 2 of the Income Tax Act says that when capital asset is converted into stock in trade, then the capital gain will have to be computed in the year of conversion by treating it as a transfer. But then the capital gains tax liability will be paid in the year in which the stock in trade is sold. Now, that specific provision was made under subsection 2 of section 45. And because of that kind of a provision, even the definition of transfer was amended under section 2 clause 47 of the Income Tax Act. Whereas under section 45(5) capital A, the year of transfer now has not been explicitly deemed, but the chargeability of capital gain will be the year in which the competent authority issues a certificate. Therefore, a question comes now, in the absence of an identical provision which is there under section 45 subsection 2, now whether for the purpose of section 45(5) capital A, the year of transfer now will have to be seen under the explicit provision of section 2 clause 47. So in that case, if you remember that, as Dr. Agarwal said, that for the purpose of making investment within a particular number of years has been given under various sections with reference to the year of transfer or from the date of transfer. So for the purpose of section 45(2)(a), the identical problem arose, because year of conversion may be say year 1, but that stock in trade is sold say in year 3 or year 4. Then the question arose in that case now whether this 3 years period or 2 years period will be recognized from year 1 when the date of transfer or the deemed transfer has been given in section 45(2), or it will be treated to be beginning from the year of sale of the stock in trade. So the board came out with a circular in which they have relaxed the rigor of this time period for the purpose of section 45(2), and they have said that that period will be counted from the date of sale of the stock in trade. Now here there is no such a circular has been issued by the board. So one can say even if it has not been issued, but the situations are in perimeteria, therefore that board circular, though issued in the context of section 45(2), that should apply mutatis mutandis to subsection 5 capital A also. Because if we do not interpret this concept of deemed transfer to be the year in which the competent authority has issued the certificate of completion, then it will bring absurdity, and a taxpayer may not be entitled to claim the benefit of these exemptions of section 54(b). So that cannot be the intention of the legislature, that you create such kind of impossibility that because of absence of this kind of an interpretation, a person should be deprived from the legitimate deductions or exemptions. Therefore, we will have to give a schematic interpretations. If you remember that in case of Manjula Shah, where the issue arose that under explanations 3I of section 48, the legislature used the expression when the asset was first held by this SSE. So the first held by this SSE, say a donee. So whether for him it will be treated as short-term capital asset, the court said no. When for the purpose of donee, the period of holding by the previous owner is taken into account. Even the cost of acquisition now relates back to the previous owner. But for the purpose of determining section 48(3), that since when this donee is holding that asset, you will have to give a schematic interpretations, because this interpretations, if not given in this manner, would create or would give absurd result. It will be inconsistent with other scheme or with the basic scheme of the taxability. So according to us, though subsection 5 capital A does not say that the year of issuance of certificate, completion certificate will be the year of transfer, but then we'll have to give schematic interpretations either for the purpose of indexation or for the purpose of claiming the exemptions under section 54, 54B or 54F, as if this year when the competent authority has issued certificate of completion now be treated as the deemed year of transfer. Only then it will make a cohesive interpretation, though the department obviously now would tend to agitate this and would say that so far as the year of transfer is concerned, the year of transfer is the year, the actual transfer. But we'll have to give a meaningful schematic interpretations, and for that, in that context, then we will have to create a deeming fixtures, even if the legislature has not deemed it in very many words. So some of you may find it, but then we'll have to bring all the provisions in harmony so as to make a sensible and meaningful reading.
Yes, I just want to add here that in the context of section 45(2), the date of conversion of capital asset to business asset has been prescribed to be the date of transfer of the asset. So there is no second thought. There is no controversy. It is provided that that is the year in which transfer has taken place. Even under section 247, the definition of transfer has also prescribed that the date of conversion shall be taken to be the date of transfer. But the chargeability to tax has been deferred in the year in which the business asset, converted business asset, is sold by the person. So when there is no doubt, there is admitted fact that the transfer has earlier taken place and the chargeability is later on, even in that case, the board has come out with the circular that the exemptions under section 54, etc., shall be available with respect to the date or the year in which the charge it is chargeable to tax, when when the asset business as a converted business asset has been sold. So then, so far as section 45(5) is concerned, it is all the more on the strong footing, because here in this case the year of transfer is not required to be prescribed, to be determined, because the chargeability, computation and taxability all are in the same year, the year in which completion certificate is being issued. When the year of transfer was the contentious issue, the determination of year transfer, therefore probably section 45(5) has been brought to the statute, and still if it is required to be determined for the purpose of calculating indexation or exemptions in section 54, then again it will defeat the purpose. And when such kind of benefit has been extended with respect to 45(2), then there is no reason that such kind of interpretation cannot be taken and should not be taken for the purpose of section 45(5)(a).
Yes. The next issue now is very interesting issue, and though a somewhat hint has been given by me in my deliberation so far. Now, if there is a specified agreement and there is a transfer of land or building or both under the specified agreement, by an individual or HUF, then this section says that the stamp duty value on the date of the issue of the said certificate of completion of the project of his share, being land or building or both. Now, stamp duty value of his share, or official means the share of the landowner. So, whether for considering the sale consideration of the land transferred to the developer, stamp duty value of the developed real estate is to be taken only for the superstructure or for the developed units as a whole, including proportionate part of the land also. Because now, if the landowner has transferred his entire land and on that land he gets back the units constructed, so the stamp duty value of the units which are constructed along with the portion of the land which already belonged to him, now whether he will be made to pay tax with reference to the stamp duty value including the cost of the land, the stamp duty value of the land, and what is the position, what should be the position, how the joint development arrangement should be drafted, that a person and who never intended to part with that part of the land on which he has to get back his real estate, developed real estate project or units, he is not made to pay tax with reference to that. Yes.
Yes, because the issue is that, as we have discussed earlier, that first we'll have to decide that at what whether there is transfer of land by landowner to the developer and to what extent. When we are saying that sale consideration is being received by the landowner as a developed real estate, say 40% of the total project, so that would imply that 40% of the land, undivided land of the entire project, has never been transferred by landowner to the developer. It is only 60% of the land which has been transferred by landowner to the developer, for which he is getting the ownership rights. When 40% developed real estate is coming or falling to the share of the landowner, then that part of the land has never been transferred. And when it has never been transferred, so there should be no question of paying capital gains on that part of the land. So to interpret that the entire land has been transferred and he would be required to pay tax on the entire the total stamp duty value of the developed real estate, which includes the land which is falling in his share of the developed real estate, has got no meaning. It becomes absurdity to my submission, because when something which has not been transferred, there is no question, and there are many judgments on this issue. When in kind real estate is being received by the land owner, then that part of land has never been transferred, never intended to be transferred, nor any rights are given to the developer for that purpose. There may be a situation when percentage of sales revenue is received or monetary consideration is received as sales consideration. In that case, we can say that entire land has been transferred by landowner to the developer, and in such a situation, the capital gains shall be attracted with respect to the entire land, and stamp duty value of the entire land may be required to be considered. But when in kind real estate, developed real estate is being received by the landowner, then that part of the land has to be excluded. Then second question becomes, then how the stamp duty value of the developed real estate of that part is to be calculated. Because in this situation, what would happen? We have transferred the land to the developer, in my example, 60%, against the consideration, which is the value of the superstructure on 40% of the land falling in the share of the landlord. So now what for calculating the sale consideration, what is required to value the to calculate, to compute the value of 40% of the superstructure, which is falling in the share of the landlord. And how this can be calculated? Because the stamp duty value is generally prescribed either of the land or of the flats, but not of the superstructure. However, I have come to know that in certain jurisdictions, even the stamp duty value of superstructure is separately provided. If it is provided, we can take it directly. But if it is not provided, then this can be computed that we take the total value of the developed flat and minus the stamp duty value of the land which is falling in the part of that particular flat. So the difference of these two can be the value of the superstructure. So there can be way how this is to be calculated, but nonetheless the point is that it is only the stamp duty value of the superstructure which can be the sale consideration for the land which has been transferred by landowners to a developer, and that land is which is falling in the share of the developer. Yes, Dr.
Yes. Now the next, so our consensus is that in this example which Dr. Raj has given, so superstructure, stamp duty value of the superstructure falling to the share of the landowner, now that alone should be deemed to be the full value of considerations along with any cash component which he has received from the developer. The next issue is relating to the interpretation of the proviso to section 45(5)(a). Now, if you remember, the proviso to section 45(5)(a) says that the benefit of this subsection 5(A) cannot be taken by a landowner if he transfers his share in the project on or before the date of issue of the completion certificate. And in case he so transfers, then the normal provisions of the taxability now will apply in the year of transfer. So you may have seen that on practical front, what happens when the project is underway and the landowner already knows that how much developed real estate unit he has to get from this project. So he enters into agreements for the sale of those units which will come into existence in future. And therefore, whether entering into the sale agreements for such units which are yet to come into existence and they will come into existence at a future date, now whether will be or can be said to be hit by the proviso, or in other words, can the landowner be said to have transferred his share in the project by entering into such kind of sale agreements of the flats or the real estate developed units which have to come into existence?
Yes, when we are interpreting the proviso prescribes that in case landowner sells the developed real estate prior to issue of the completion certificate, then the provision of section 45(5)(a) will not be applicable, and rightly so. But whether this situation may arise, because generally speaking, the right to transfer any developed real estate or flat or unit which has been developed in the project, that is available only when completion certificate has been issued. Prior to that, no conveyance deed or sale deed can be executed either by the developer or by the landowner to the customers. So the term when the developed real estate has been sold, so has been sold means the legal ownership has been transferred by the landowner to the customers. Only then, because the part of the developed real estate which is falling in the share of the landowner, he has got the right to dispose or sell that developed real estate to anybody. He can directly do it, or he can do it through developer also. But if whether this kind of situation may arise, again, because there are different state laws so far as the conveyance deed and registration and issuing of the occupation certificate, completion certificate, etc. is concerned in different states. There may be certain jurisdiction where conveyance deed is permitted even before issue of the completion certificate. Yeah, I have come to know that in certain states, earlier occupation certificate is issued and later on completion certificate is issued. An occupation certificate gives the right to transfer or to execute conveyance deed. So to my mind, in such a situation, execution, even occupation certificate may take the character of the completion certificate if he has got the right. But without going into that detail or controversy or in that aspect, the only point is that there may be rare cases where it is possible that even prior to the completion certificate being issued, the right to transfer the asset may arise. But nonetheless, it may happen. But if that happens, then this proviso is significant. And it is rightly provided that if you have already transferred the developed real estate and still you are not taxed, and you are the tax is you are not taxed on the land which has been transferred by you to the developer, because against the land which has been transferred by you to the developer, you got the developed real estate, and that developed real estate has also been sold by you. In that situation, the taxability will not be governed by section 45(5)(a), but the normal provision of section 45(1) will come into play. And that would imply that the year when the transfer of the developed real estate has been made by the landowner to the customers, in that year only, under section 45(1), the taxability even of the land which has been given by the landowner to the developer would arise. That is the proviso which has been prescribed. But because in all these transactions, the taxability is at two steps. One is taxability when the land is being transferred by landowner to a developer, and 45(5)(a) is discussing the taxability of that land which is being transferred by the land owner to the developer. And second part may be that after after getting the possession or the ownership of the developed real estate, the landlord will further sell those developed real estate. Then at that point of time also, the taxability of the developed real estate may arise. Again, there is a question on this issue also, and it has been prescribed under section 49 subsection 7 that in such a situation, when the developed real estate or developed flat is sold by the landowner, then the cost for acquisition of that flat will be taken to be the amount on which he has already paid the taxes. Means the stamp duty value of the developed of the land which has been transferred to the developer. That stamp duty on that stamp duty value, he has already paid the tax under section 45(5)(a), and that will be taken to be the cost, and whatever the value is further fetched from the sale of the developed real estate, the difference of these two would be the capital gains arising to the landlord at second step. But again, there may be the question that holding period, what would be the holding period, whether long term, it will be long term or short term, depending upon the years to which holding is there. Again, the controversy may arise on this issue also, whether from the date of getting the possession till the sale, the period is to be taken, or the period of holding is to be seen, because it is the improvement in the land. Land was already owned by the landowner. Superstructure has been created by the developer, and therefore the holding period should be from the holding of the land and not from the holding of the developed real estate. Then this may be another controversy which may be required to be addressed or which may be discussed. But the point which I was discussing regarding the proviso, that if you have already sold, then it will be taxable in that year under section 45(1). 45(5)(a) will not be applicable. But now another issue which our question is that if you have not sold, means the ownership has not been transferred, but we have only entered into the agreement to sell, and which generally happens that along with the project, either owner directly or through the developer on his behalf may enter into the agreement to sell with the customers. So whether to enter into the agreement to sell can be said that we have sold, to my mind, no. Unless the ownership has been transferred, it cannot be said. And therefore, entering into agreement to sell would not be hit by this proviso, in our opinion. And again, in this case also, the taxability shall be in two steps. one step when completion certificate is issued, and after that, when developed unit will be sold, then as I already discussed on the difference part, at that point of time, taxability will arise. But only to enter into the agreement to sell would not imply or would not mean that this proviso will be hit. Dr. Gupta.
Yes. Now the next issue is relating to its interplay, if at all, it is there, of section 50C with section 50C. Now, when we read section 45(5)(a), now it says that the stamp duty value as on the date of completion certificate, now that will be deemed to be the full value of consideration. So it only provides this much. But then what would happen? Now, in case the real fair market value of the developed real estate is lesser than the stamp duty value, because under section 50C, subsection 2, that the assessee can make a claim before the assessing officer in case the fair market value is less than the stamp duty value. And if he makes a claim, then the assessing officer may appoint a district valuation officer for determining the fair market value. So in that context, a question arises. Now, so far as the real fair market value being higher than the stamp duty value is concerned, now that is of no concern in case of section 50C, and that is of no concern here for the purpose of section 45(5)(a). But then what would happen in case the fair market value is lesser than the stamp duty value? Now, whether this assessee, who is an individual HUF, can make a claim before the assessing officer on the lines of subsection 2 of section 50C, that is the question. Because ostensibly, apparently, now it doesn't say anything. It provides an absolute answer that stamp duty value shall be deemed to the full value of consideration. And 45(5)(a), but then at the same time, it has to be borne in mind that is non-obstante to the extent of subsection 1 of section 45. Therefore, a claim may be made, this is a plausible interpretation, that section 50C has not been excluded, and therefore the benefit of making a claim under the provisions of section 2 of section 50C now should be taken to be existing as an implicit enabling provision under section 45(5)(a) in case the real fair market value is less than the stamp duty value. Yes, Dr.
Yes, as Dr. Gupta has rightly said, that though it is not specifically provided under section 45(5)(a), but nonetheless, one can take the clue from the provision of subsection 2 of section 50C, and one can plead that since fair market value is less than the stamp duty value, then it should be taken to be the full value of the consideration. Or alternatively, he can challenge the stamp duty value with the stamp duty authority. And if the reward is granted there, lowering the stamp duty value, then also the objective is served. And probably that would be a better proposition, that to challenge the stamp duty value with the stamp duty authority for this purpose.
Next, again, very interesting question. Now is there on the interpretation of subsection 5 of section 45 with respect to a situation where the completion certificate of whole of the project is not seen, but then it is received in respect of the part of the project. Now, if we go by the rule of literal construction subsection 5 capital A, now it seeks to tax the capital gain in the year in which completion certificate for whole or part of the project is issued. So, if the completion certificate is issued for part of the project, now even in that situation, whether the complete capital gain with reference to the entire project is able to be taxed, or it is to be taxed on proportionate basis. So if you remember that under section 80(IB), when there were conditions attached to the housing project that each unit in that project, I mean, if it has been made or built over a specified area, then each unit should not be of more than 1000 square feet or 1500 square feet. And in that project, if certain units transgress that threshold, the question arose whether the benefit of 80IB is lost completely or benefit of section 80IB will have to be allowed in respect of that part of the project which complied with all these threshold limits. So in that context, now the question here is, even if the completion certificate is received or is issued for part of the project, now whether the entire capital gain for the whole of the project is taxable. Yes.
So the project may be of such a nature that it is on say 10 acres of land in which 8 towers are being constructed, and out of 8 towers, only 2 towers have been developed initially, and completion certificate is issued for 2 towers, because if these becomes habitable and all amenities are available, then completion certificate is issued. Because only after that you can have the conveyance deed executed to the customers. So if part of the project has been completed and completion certificate has been issued for part of the project, then the reasonable and correct interpretation of this phraseology would be that the taxability only of the proportionate land which is involved in the part of the project for which completion certificate has been issued can only be brought to tax. The entire land cannot be brought to tax. In big projects, only completion certificate is issued in so many installments, so many phases. Maybe initially only 5% and 10% of the project is complete, for which completion certificate is issued. On that basis, to tax entire 100% of land does not seem to be reasonable.
So, in sum and substance, the proportionate capital gains with reference to that portion of the land on which the project is completed now alone would be taxable. The next issue, as Rajji has also discussed briefly while giving answers to one of the questions, that what would happen or what would be the cost of acquisition of the developed real estate units which fell to the share of the land developer after the development of the project, when that landowner sells it thereafter, and whether capital gain arising thereafter would be treated as a short term or long term. So, as Rajji has said, that there is section 49 subsection 7 which says about the cost of acquisition. It says that the stamp duty value with reference to which the capital gains tax have been paid now will become the cost of acquisition, and a specific provision has been made under section 49 subsection 7. Right, Rajji?
Yes. Along with if it is only the superstructure, then the cost of the proportionate land is also to be added to this.
Yes, that in there. But then the question whether it will be long term or short term.
Yes.
That is a very tricky question. And today I came across with one decision from Honorable Karnataka High Court, and probably its citation is 288 Taxmann 243, in which Karnataka High Court took a view by saying that if the land is long term, though the land and superstructures are two separate, distinct and independent assets, capital assets, and this is so settled by Supreme Court long back in Alps Theatres case 65 ITR at page 73. But despite that kind of distinctions between these two kinds of assets in that decision, if the land is long term, then the superstructure which is built thereon, and in the Karnataka High Court has held in that case, and the name of the decision Anant Ram, some 288 Taxmann 243, said that the capital gain would be long term capital gain, and that too with reference to the land. And but then I personally may beg to differ, but then that is decision which is available coming from Honorable High Court, therefore that can be made use of.
But in that case, superstructure may take the character of being improvement in the value of the asset.
Yeah. So yes, Because we always say that if there is a gold, and if jewelry is made out of gold and the jewelry is sold, now whether that jewelry which is sold now will, if in case the gold is held for more than 36 months, now whether the jewelry can be said to have been to be treated as a long-term capital asset or short-term capital asset. So it is a case of improvement of a capital asset which was gold, or it is altogether a new asset which has come, probably has gone by this philosophy that the superstructure of the land is the improvement of the land, and therefore the period of holding of land. Now, if it is treated as the long term, then the capital gain arising on the transfer of such, that would also, such capital asset would also be long term capital asset. But then this is a view, I mean, which cannot be taken. But of course, within the jurisdiction of Karnataka High Court, I mean, that has got the binding precedent and therefore can be made use of. The next issue. Now, what would happen in case the landowner converts his land into stock and then enters into the JDA? Now, whether and all other conditions given under subsection 5 capital section 45 are met. Now, whether the benefit of 45(5)(a) would be available in such a case? Yes, Dr. Raj.
This 45(5) is applicable only when the land is in the nature of capital asset. Because we are talking of calculation of the capital gains tax, it falls in the chapter of capital gains. 45(5)(a) is only for the capital asset. So if it is a business asset, either converted or right from the inception it is held by the assessee as a business asset, in that case provision of section 45(5)(a) will not be applicable, and it is in fact not required, because the controversy or the complexity or the difficulty was with respect to the land when it was in the nature of capital asset, when it was being transferred to the developer, while at the time of entering into JDA, whether it will constitute to be transferred, whether it falls within the definition of section 247 at that point of time only. Because if it is a business asset, then the definition of transfer of section 247 is not applicable. In that case, the taxability of the business asset arises only when there is, the revenue recognition principles of accounting standards 9 will have to be looked into. And there, the significant risk and reward, when these are transferred, when the significant risk and reward is transferred, only then the question of taxability of the income on the transfer of the business asset will arise. And that significant risk and reward would arise only when the legal ownership is being transferred by the landowner to the developer. So I mean, maybe that in the case of business asset, 45(5)(a) neither would be applicable nor may be warranted.
Now, the next question, I mean, which comes to our mind is as to when the non-refundable security deposit received by the landowner from the developer now would be taxable. And similarly, if the cash component which is received, say initially at the time of entering the joint development specified agreement by the landowner from the developer, now would be taxable at which point of time in which year? Yes.
Yes, because at the time of entering into joint development agreement, generally certain amount in monetary terms is given by the developer to the landowner, which may be in the nature of earnest money or security deposit or some advance amount, which may be either refundable or non-refundable. But irrespective of the character being refundable or non-refundable, if it is part of the total sale consideration, then the taxability of the entire amount would be in the year in which the capital gains are being taxed, and in the context of section 45(5)(a), it would be the year in which completion certificate for the project is issued by the competent authority. Then even the non-refundable part of the security, if it is part of the total sale consideration, that is the crux, that is the issue to be decided, whether that non-refundable security is part of the total sale consideration. But when the security is being received as a consequence of the entering into the JDA, So naturally, it is only for the purpose of, it is only part of the sale consideration. Otherwise, there is no other business transaction between the landowner and the developer. So the non-refundable part is only for the purpose that in case developer backs out from the agreement, in that case, this part will not be refunded. This will be forfeited. So initially, if the JDA goes through and it keeps on as a going concern, it is going on, then even non-refundable part would be the part of the total sale consideration, and it will be added to the value of the sale consideration and taxable in the year in which completion certificate is issued. But for example, in case the joint development agreement falls apart in between, and this non-refundable part is forfeited by the landowner, it is not paid to the developer, then the year in which it is forfeited, it should be brought to tax in that year. Otherwise, in normal circumstances, as a going concern, it will not be taxable initially, but rather as part of the sale consideration.
Yes. Now, whether profit on sale of developed real estate shall be taxable as capital gain or business income in the hands of landowner, because the landowner, now after the receipt of chunk of developed real estate units, now he makes he goes on the selling spree. So in that context, the question arises, since he is making sale after sale of the real estate developed units, now whether the gain which is resulting to him now would be assessable as business income. Can it be taken to be an activity in the nature of trade? Can it be taken as if he is undertaking a systematic and organized activity of selling, and therefore the income resulting from it now should be assessed as business income, or it will still be assessable as the capital gain?
Yes. So far as this question is concerned, here the issue is that we have to decide whether the landowner is involved in any kind of business activity, whether the asset is in the nature of business asset. So the principles which have been laid down in different judgments of the apex court, that when an asset can be said to be a capital asset or when it can be said to be a business asset. Those principles are to be examined and to be applied to address this kind of controversy and this kind of question. Here, this question has arisen that, for example, that against the 10 acres of land which has been given by the land owner, for example, and he has got 100 developed units of the flats. And now, if 100 developed units are received by him, so till the units are received and land is transferred, it is capital asset. The capital gains arises on the transfer of the original land, and stamp duty value of the land as on the date of the completion issue of completion certificate shall be the taxability. But after that, if those 100 units are sold year by year in to different customers, then whether the character has now taken to be in the nature of business, that you are not this is not a single unit or 2 units or capital asset. Now you are involved in the activity of the business. So again, the principle, first of all, I mean, there can be arguments both the sides. The first thing is that landowner has never involved in the business activity. Whatever the development has been made, it has been made by the developer. It is only that his big land has been divided into small pieces of flats, which have been developed by the developer and handed over to him. So instead of holding one asset, now he's holding 100 different assets. So that does not mean that it becomes a business asset, because there are no instances when if a person is holding 10 capital assets or 100 capital assets, it can be said that he is involved in the business activity, unless he is doing the business of real estate itself. So only to, I mean, there are so many principles, so many criteria which will be laid down, that what is the intention of holding the asset, how it has been shown in your profit and loss account, how it has been developed, whether any value addition or any other organized activity has been done. So he has not done even any organized activity also. If he makes value addition, he makes furnishing of each flat and then sells it, then we can say that some business activity is being done. But if he is getting the developed units from the builder, the number of volume might have increased from 1 to 100. But to my mind, it cannot be said that he is involved in the business activity, but it will still remain capital asset and capital gains would be taxed. And even with the in the context of 49(7), also they have recognized that it will remain capital asset. Therefore, the cost of acquisition they have provided for all the developed real estate as per the in this section of 49(7). So 49(7) prescribing in 49(7) to be the cost of the capital asset itself is, validating that it will still remain capital asset.
Yes. So Dr. Agarwal, so the everything revolves around as to whether this is merely the activity of selling the developed real estate units which fell to his share, or having received those real estate developed units. Now, if he undertakes some activity in the nature of trade, so that in that situation, the business profit and the capital gain will have to be segregated. So now there are other questions, but then we have got certain questions in questions and answers box. And I think if we take, and because then we are left with almost 15 minutes, so let us see as to what are the questions in the questions answers. Yes. First is good afternoon, Rakesh sir. Good afternoon. This anonymous attendee. If any agriculture land is purchased, are you seeing, Raji?
Yes, I am listening.
If any agricultural land is purchased and sold within the same year, minimum 1 month, maximum 1 year, whether any kind of income tax, as it is not a capital asset, on income of sale, on income on sale of agriculture land will be applicable. Any specific angle to be kept in mind preparing the return involving such transactions? Thank you. So, in fact, we cannot make such a blanket statement that if an agricultural land is purchased and sold within the same year, it will not be capital asset. There will not be any capital gains tax liability, because if it is a rural agricultural land, if it is not a capital asset under section 2 clause 14 of the Income Tax Act, only then we can make such kind of a statement. Otherwise, urban agricultural land purchased and sold maybe in 1 year or maybe thereafter, now will give rise to capital gain. So, but then let us assume probably the nature of agricultural land which appears to be in the mind of the querist is that it is a rural agricultural land and it is not a capital asset. So, if it is that kind of a non-capital asset, rural agricultural land, then you must ensure that it is entered into the records of the revenue as agricultural land on which agricultural operations are being undertaken. So these two things must be borne in mind, and then you can claim it to be the agriculture. And of course, it should be situated within or outside the municipal limits of different populations as given in section 2 clause 40 of the Income Tax Act. Assuming that land strictly falls within the, okay, so if it falls within the definition of agricultural land, but then that itself is not enough. That agricultural land should not only be an agricultural land in the record, but then actual agricultural operations also must be. If there is a temporary cessation of the agricultural operations, all right. Yes. Mr. John.
Next question.
Pardon?
Next question.
If the landowner gives power to developer to develop the land and gives possession of the land, can we say that the land is transferred? Yes, Dr. Agarwal.
Yes, because this was the entire controversy. Because at the time of entering into joint development agreement, if possession is handed over, then whether it can be said it is a transfer. So now there are ample judgments from the highest court that mere handing over the possession of physical possession for the purpose of construction or development of the project is not cannot be said to be the transfer of the capital asset. The transfer can be said only when all ownership rights have been transferred by the landowner to the developer. And ownership rights would mean that the developer is in a position to use or dispose or sell the land in the manner he wants without any interference of the landowner at his own discretion, sole discretion. Only then it can be said that the ownership rights have been received. So if the JDA terms, we will have to read and go through the terms of all the joint development agreement terms. Sorry, terms of the joint development agreement and make out whether complete rights of ownership have been transferred. Effective control of the land has been transferred to the land to the developer. Only then it can be said the transfer has taken place. Mere handing over the possession is not sufficient.
So to give possessions merely as a licensee for
Yes.
undertaking the developmental activity is not transfer, because the legislature has used the word transfer, and therefore the word transfer will have to be seen in the prism and in the light of section 2 clause 47 of the Income Tax Act.
The interpretation of Chaturved Das Kapadia, which was being made earlier, now has been diluted in so many cases later on. So many cases.
Balbir Singh Mani.
Balbir Singh Mani is there,
Yes,
National Minerals is there, so many cases. Yes.
Yes. Now next is from Mr. R.K. Soni, whether section 45(5) is applicable if land is held as stock in trade. No, because it uses the expression that it has to be capital asset. Capital asset, transfer of capital asset being land or building or both. So it has to be stock in trade. Stock in trade is not capital asset. If you read the definition of section 2 clause 14 of the Income Tax Act regarding, it says stock in trade is not capital asset. Next is section 45(5)(a) applicable to trust or company? No. Now when the legislature has sought to give this benefit to individual and HUF, then obviously all other entities are excluded, and therefore the trust and company will not be covered under the scope of section 45(5)(a). Even sales consideration received 1% in kind and 99% in cash, there is no, yes, you are right. So if partly in kind and 99% in cash is all right, because it has not been spelled out in the definition of the specified agreement. It says that part of the considerations to be in kind and 1%. So there is no concept of the dominant character of the considerations, of the nature of consideration. Okay, Doctor?
Yes, it's fine.
Request to please speak on the taxability and year of taxation and valuation from point of view of the developer. Yes.
So as I said, that this is such a big topic, and entire topic cannot be covered in one program. So we would like this to be covered in 3 programs, 3 webinars. One, today we have discussed section 45(5)(a), which means that taxability for the landowner being individual or HUF. Then second part can be taxability for landowner being other than individual or HUF. That is companies, partnership firms, LL.B, etc. or trust society. And the third part can be taxability in the hands of the developer, because there are so many issues from the point of the developer also. So whenever we will get the time, we will coordinate with Taxmann and we'll try to address these 2 issues also in 2 different programs later on.
Mazhar Alvi साहब कह रहे हैं, would section 45(5)(a) apply in case a joint development agreement is entered into for development and sale of plots of land? If yes, at what time capital gains would arise for the landowner?
Yes, it can be a project of development of the housing or flats, or it can be a project of only plotting, where the plotted colony is developed, in which roads are constructed, electricity is provided, water, sewerage, STP, etc. is provided. It can be that kind of project also. And for such project also, completion certificate is required from the competent authority. So again, the same principles would be applicable in such kind of project also.
And how to disclose the same in the ITR while filing? So, yes, ka to matlab, I mean, we could not understand the meaning of this question. And Kiran Kumar ji is saying, so we have to calculate full value of considerations only for the portion of transfer to developer, that is 60% in your example.
Yes, 60% of land is being transferred to the developer, for which consideration is value of superstructure on the 40% of the land falling in the share of the landowner.
So
the value is to be calculated for the 40% superstructure which is falling in the share of the landowner, and that is the consideration for the 60% of the land being transferred to the developer.
Yes. So stability value referable to 40% superstructure or superstructure constructed on 40% of the land, that will constitute the full value of consideration for the transfer of 60% of land. Shubham Rastogi, sir, please deliberate that whether for the purpose of computation of consideration under section 48, stability value to be taken on the date of completion certificate between the value of land of a share in the land covered under the specified agreement or the value of constructed flats received under agreement. Yes, Dr.
We have already discussed this issue. Again, the issue is, in our opinion, it should be only the superstructure, value of superstructure. For the stamp duty, value of superstructure has to be calculated. The method of calculation may differ from case to case and depending upon the jurisdiction in which it is falling. As I said, that in certain jurisdiction, even the stamp duty value for the superstructure has been provided. But if it is not provided, then the differential amount of the value of the flat minus the value of the land may be taken.
Whether advance taken by the landowner before receiving the completion certificate would amount to violation of section 45(5)(a)? No, because it should be the transfer of a share in the project. So the receipt of advance by the landowner before receiving the completion certificate is not equivalent to the transfer of a share in the project, and therefore 45(5)(a) will not be considered to have been violated. What would be the cost of acquisitions for the landowner under section 45(5)(a) arrangement? Yes. Yes, Dr. Agarwal.
What would be the cost of acquisition
for the landowner? What is the actual cost to them, or fair market value if it has been acquired prior to 2001?
Yes, we have to see the cost which is to the landowner. As Dr. Gupta said, that if it has been acquired prior to 1st April 2001, then the stamp duty value as on 1st April 2001 is to be taken. Otherwise, the actual cost and then indexing can be done on that, and it has to be done on that.
Sir, how do we represent under section 50(c)(2) when the return is filed by considering stamp duty value, as the portal otherwise will not validate the return? This regarding how the return is to be filed is not my cup of tea, because we have gone distantly ahead or backward, I mean whatever manner you want to say, regarding the filing of return. Therefore, we are sorry. Dr. Agarwal, if you can throw some light on this.
No. Again, I will not be able to tell, because what I understand, that while filing the return, it is required to fill the value of consideration and value as per section 50(c). What is the stamp duty value? And if we are saying that the fair market value is less than the stamp duty value, and with respect to that we are offering the capital gains, then how it is to be spelled out in the return, this is to be looked into. I mean, the way the form is has been created, it is to be filled, it is to be seen. Otherwise, whenever such kind of situation is being created, as a general rule, probably I will not be able to give you much guidelines on this, how this situation is to be tackled.
Sir, if car parking is sold by landowner, will it form part of capital gain or other sources or business income, as car parking is not generally part of sale deed? So for the landowner, if his car parking is there, I mean for him that this was the capital asset which has come to him as the developed real estate. So it will be taxed under that capital gain only. It's not business income or other sources, unless the entire project after the receipt has been so structured by the landowner so as to give us color as assets or business assets. In that situation, it may be a different situation. Kamal Arora sir, hello sir, I understand that there was a judgment which held that if appropriate stability is not paid on agreement to sell, and even if possession is given along with all rights, it will still not be transferred. Yes, you are correct, because Balveer Singh's Benny's decision says that even agreement to sell has to be registered. And the amendment made in the Registrations Act in section 17 and section 49, now that should be complied with, only then it can be treated to be an agreement as referred to in section 53 of the Transfer of Property Act. Shubham Rastogi sir, refundable security deposit is either adjusted from the value of flats to be received or refunded in phases as and when possession received. Whether, no, now if something now which cannot be said to be part of sales considerations cannot be part of sales consideration. You are right. Kindly guide us on JDA for a property received under a gift or inheritance. Yes.
Yes, if property has been received as a gift or inheritance, then the value as on 1st April 2001, if it has been received at that point of time or prior to that, otherwise the cost to the previous owner is to be taken and then indexing is to be done to work out the cost of acquisition of such land.
So merely receipt of the land under a gift or inheritance will not change the character of the taxability of the JDA. That is what. Yes, Mahesh ji क्या कह रहे हैं? In revenue sharing model of JDA, whether developer is obliged to deduct TDS under section 194 IC at the time of revenue sharing with landowner through escrow account. Yes.
I am not sure. We will have to check whether under JDA TDS requirement is there or not. Probably it is not.
194 IC is there.
Probably it is. I am not. We will have to check it.
Thank you for your wonderful sessions. Thank you for your compliment. Can you throw light on taxation of redeveloped flat received by a member of society and subsequent sale by the member? Now we will touch all these aspects in our next webinar. Many thanks for lucid Kiran. In ITR, while filing date of transfer will take only particular financial year, say financial 21-22. Though date of transfer is date of JDA, maybe 3 years ago, say financial 18-19, which will affect indexation benefit. No. Probably your question is not clear, but then let us make ourselves clear. According to our interpretations, though the year of transfer now has not been deemed to be the year when the completion certificate is issued, but according to us, in view of the schematic interpretations of all these sections and to bring harmony in interpretations of all these sections, we'll have to do indexations till the year of the issue of completion certificate. Sir, my question of 50C2 was where return cannot be filed to claim fair market value. How do you represent before the assessing officer unless the case is taken over? Yes, that is there. So you show your capital gain based on the real fair market value, which is less than the stability value. That itself is a claim made by you in the return of income. In case your case is not selected in scrutiny, you will be assessed with reference to that reduced fair market value. In case your case is selected for scrutiny, obviously you will get an opportunity to make your claim further buttressed by your further explicit claim, which you will make through a letter. So I think now it is 6. Time is over, but then there is one chat also. Let us see what is there in the chat. No video. Okay. It is too late. So thank you from my side, from Dr. Raj's side.